This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. Welcome to the Wealth Roundup for the week of August 13th, 2025 with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Summer is always a challenge with time off, vacation, and that sort of thing. The last time we spoke was the third week of July, but there was a podcast on the, July 30th week. So I guess that leaves us with 12, 13 days since then. What have the markets been doing in the first half of August here, Patrick?
I would concur the markets took their own little bit of a séjour. We had some U.S. Job data came in that was, I think some people would say maybe it was disappointing. Others would say it was expected. So U.S. job numbers, they really were running tight on labor, just below 4%. They moved up to 4.25%. And on that weaker job data, stocks came down, gold down, oil down, Bitcoin down. But I also think it's light trading. People are on holidays. The number of U.S. Stocks trading above their 50-day moving average is only about 50% right now, whereas, say, 2 months ago it was about 80%. This will probably continue in through the September long weekend.
With the things that happen in Canada compared to the things that happen in the United States, I know we just recently went through another Bank of Canada non-change for the bank rate. It was probably due to inflation, but U.S. core inflation down south of the border in July moved higher. Why does this matter for us here in Canada with investing?
Yeah, so this is this tug of war between the White House and the Fed. Trump wanting his interest rate cut, the Fed being stubborn, following their mandate, keeping rates higher in order to prevent inflation from coming back. We've all been waiting for the tariffs to push prices higher in the US. We started to see interest rates coming up in May and then again in June, and then a really robust increase of about 0.32 here for July. So this is exactly what we thought would happen. But on the plus side, this July print came in about where we thought it would. So we can look at it in two ways, is that yes, inflation is kind of trending through, probably due to higher prices. And now the Fed needs to make a decision on whether or not they're going to cut rates. Now, the US central bank interest rates are quite a bit higher than they are here in Canada. So if we're sitting at around 2.75, the US is sitting around 4.5. We would say they've got restrictive rates. And this is why the White House and probably lots of other market makers in the US, they want lower rates. The lower rates will lead to lower mortgage rates in the US, lower rates on big ticket purchase items. The stock market likes lower rates. The bond market likes lower rates. So everybody's clamoring for lower rates. And we think we're probably going to get a US rate cut now in September, largely because this inflation was expected to tick up. It has ticked up, but the amount that has ticked up is in line with where our thoughts were. Why is it important? The direction of interest rates.
And I saw an article yesterday saying that there is speculation that the interest rates in Canada may come down again before the end of the year. So whether it happens at the next announcement from the Bank of Canada or perhaps later remains to be seen. Plus, at some point, I would like somebody to sit down with a crayon or a box of crayons and explain how this tariffs thing is supposed to benefit the U.S. or Canada or anybody for that matter, because I don't get it.
Yes, when we knew tariffs were coming, my expectations on how much revenue the U.S. was going to generate based on tariffs is that I just didn't see the math. And, Trump kept on talking about how these tariffs were going to lead to so much revenue that maybe they wouldn't even have to collect taxes from Americans anymore. They'd just be able to have everyone else pay their taxes. Now, we'll have to wait to see. Lots of these trade deals are still up in the air. Just today, the trade deal with China got punted down the road another 90 days. So we still have, there's still lots of clouds in around where we are going to end up. Our house view is that we're looking at kind of a global tariff policy of a roughly 15%. And that 15% is going to get split between consumers and retailers. and manufacturers. But what it should lead to is tariffs are a tax on consumption. Eventually, it's going to mean people are going to be consuming less. If they're consuming less, businesses are selling less. Businesses are selling less, profits come down, businesses have to lay off people. That's where the end game should be.
I'm not an economist, but I kind of figured that out myself. But I thought maybe, well, maybe it's just so simple that I'm wrong. We've kind of talked about the opportunity to invest in Canadian energy. Is Canada an energy superpower? Is that what we should be labeled as?
So I wanted to talk about this today because as we're obviously negotiating with the U.S. and we don't want to do a bad deal. We've got this U.S. Mexican Canadian trade agreement in place, and which covers about 85% of the exports, or 85% of the trade that we have with the U.S. right now. My guess is that the Canadian trade team is kind of really looking for our next opportunity to combat what has been kind of feels like an attack on the Canadian economy. So you start to look for where your positions of strength are. And we clearly have more energy here in Canada than we need. Now, here in Alberta, when we think of energy, we primarily think of Canadian crude oil. And that's clearly our bread and butter. We Canada exports about it's about $130 billion worth of Canadian crude to the United States. So our single largest export. But we have other components of our economy where I think there is more room for expansion. Natural gas, we export about $13 billion USD value worth of natural gas. The only country that the US imports natural gas from is Canada. The only country that the United States imports electricity from is Canada. So as US energy demands increase, which we think they will, this is really an opportunity for Canada to kind of flex its muscles in this particular department. And so when we're kind of looking for opportunities, I do think that this is a place where we can grow, even if it's not on the crude oil side, is certainly on the natural gas and on the electricity side. So where I'm seeing the catalyst here is when we talk about energy needs in the US. And so if there's been a lot of talk about these data centers, these new data centers that are going to be required as the build out for artificial intelligence expands, as the build out for cloud computing expands. And so right now, those data centers account for about 4% of total energy usage in the United States. Well, Goldman Sachs recently sent out a paper where they feel that by 2028, that's going to triple in terms of how much energy those data centers are going to use. Now, probably the long-term solution for the US is probably nuclear power, but you can't just put a nuclear power plant on the corner of your street beside your Circle K. It takes a long time to build it out. Nobody really wants to have a nuclear power plant in their backyard. So it's not like that's going to happen overnight. So in the short term, it's going to be Canadian natural gas and it's going to be Canadian electricity, of which a lot of those are renewable. And aside from just the US being a customer, as we kind of dig deeper into a lot of these Canadian utility companies like ATCO and Fortis and Emera, and a lot of these pipeline companies like Enbridge and Pembina, that we see that they don't just operate in Canada, that we actually have that those companies are operating as energy utilities in places as far away as the Bahamas and Australia and Taiwan. So Canada is exporting their know-how on the energy side beyond just the United States. In one of our previous podcasts, we had talked about the success of LNG Canada. So shipping LNG overseas, so getting our energy to Tidewater, finding export markets besides the United States. And so when we had our podcast in July, we had talked about the success of that first shipment. So that first shipment had gone off to South Korea. Well, a shipment of an LNG tanker vessel, the amount of LNG that would be on one of those shipments accounts to about $330 million per shipment at market value in US dollars. The more that the US continues to consume, the more that Canada looks beyond some of its traditional markets for energy, is that, yes, I think that we become a multi-dimensional energy superpower. And I think that this becomes a bargaining chip that we'll be able to leverage as we counter probably this new trade arrangement that we have with the United States.
Very good. So it's not necessarily just the guys with the propellers on their heads, like Nvidia and that sort of thing, but it's also the companies that provide the infrastructure in order for those to work that is worth some reading.
Yeah, and I think traditionally we've always thought of utility stocks as kind of boring, but as this energy build out accelerates, is that some of these boring stocks they become more profitable, and so they can compete with maybe some of the sexier ideas that are around technology and information technology and AI.
As always, due diligence is encouraged, and reading and educating yourself on everything that we talk about here. The Wealth Roundup for the week of August 13th with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Thanks, Patrick.
Have a great week, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.